This is not financial advice. I'm recording my thoughts about C3.ai, which is an enterprise AI software company. This company offers very high stock-based compensation, almost no growth, like single-digit growth or less, and its CEO is very confused about its future growth. Yet, this company's stock price doubled in May due to the AI hype and because AI is in its ticker. But after they've announced their recent earnings, the stock is down about 18%. It's currently trading at about $32. So now we have to see whether this is a good entry point or not. A few weeks ago, when the stock price reached $29 from about $13, I said it's a sell based on the valuation that I'm showing on the screen. I'm seeing 0% gain in the next 5 years at $29, and therefore I suggested to sell. But they announced their earnings today and they gave the future guidance, so maybe things have changed. Let's quickly look at its earnings, future guidance, and also the future valuation to see where the stock would be in 2027. In the most recent year, they grew their revenue by about 5.6%. That's single digit growth to about $266 million. And in the most recent quarter, they made about $72 million of revenue. 72 million seems good, right? But notice that they did not give percentage growth year on year because it's flat. It's almost 0% growth when compared to the past year. Look at the net loss of 58 cents. This company is nowhere near profitability. For the forward guidance, they're saying they can get about $295 million to about $320 million of revenue. But even if they achieve $320 million of revenue, that only represents 20% year-on-year growth. And the positive thing is C3.ai is planning to reduce its exposure to defense and oil and gas sectors for its revenue. So that's definitely good news. But why the stock has gone up significantly? What is the reason? That's because of their generative AI solution for enterprise. And note that they have not developed it. They have simply integrated a generative AI solution to their suite of products. So on to the valuation. Let's quickly look at their stock-based compensation. They offered about $48 million of stock-based compensation. That's about 70% of the revenue. $72 million was their latest revenue, right? Out of that $72 million of revenue, they offered $49 million of stock-based compensation. This got to be some sort of record, and obviously the investors do not pay attention to this. They see the ticker AI and then they buy the stock. Let's look at the valuation to decide whether to buy the stock at this price or not. As usual, I'm going to give two cases, one with reasonable assumptions and the other with great execution. In the reasonable assumptions case, I'm assuming that in 2023, they'll meet the upper limit of the guidance of $320 million. So in 2023, I'm assuming that they can get to that $320 million of revenue, and I'm assuming 20% growth rate. Note that this company only grew about 5.6% in the past year and is guiding for 20% as the upper limit. So as the company grows bigger and bigger, it's hard to grow. And yet I'm assuming 20% revenue growth for this company, which is optimistic, with which they can make about $660 million of revenue in 2027. This company's gross margins are in the order of 75 to 80%. So I'm assuming 25% net profit margin, with which they can make about $165 million of net income in 2027. For a company that's grows in the 20% range and has a 25% net profit margin, I can assign a multiple of 22.5, but since C3.ai has AI in its ticker, I'm going to give it a premium multiple of 27.5, with which this company would be worth about $4.5 billion in 2027. Remember that this company is famous for offering very high amount of stock-based compensation. This company currently has about 112 million outstanding shares, and I'm only assuming 5% dilution, which is very optimistic. With that, they will have about 136 million outstanding shares in 2027. Divide the $4.56 billion of market cap with 136 million outstanding shares, I get a stock price of $34 in 2027. But current stock price is $32, right? So that's 5% gain in 5 years, which is not at all a good gain. Let's look at the great execution case. I'm assuming 25% growth rate, which is extremely optimistic. And I'm thinking that with great execution, they can get that, but it's not very possible. And I'm assuming a net profit margin of 27%, which is hard to do. And I'm also giving a premium multiple of 30. I'm assuming the same dilution. With that, they will have about $46 stock price in 2027. When compared to $32 current stock price, that's about 45% in the great execution case. For my personal investing journey, I rely on the case with reasonable assumptions, in which I am estimating a $34 price target in 2027. So for me to get a 2x, the stock has to fall below $17. And if it falls below $17, I'll think about starting a position in C3.ai. But otherwise, I don't like this company offering. Not like the fact that they give a lot of stock-based compensation. The growth rate is very, very low for the kind of multiple that it currently has. Let me know your thoughts in the comments. Thank you so much for watching.